I will teach you how to turn $100 into $1,000 by leveraging the stock market in this simple 7-step process. I put this strategy to work and it's already grown my Schwab account from $69,000 to over $125,000 just in 2025. 90% of traders lose 90% of their money in the first 90 days of getting started. And if that was you, it's likely because you haven't implemented this step-by-step framework that I'm going to teach you in today's video. Once you learn how to apply this framework, your account will go from this to this. And this is the same exact framework that took my first $100 into well over $1,000. But in this video, I'm going to be giving it all away for free because I strive to plant a seed in all of you, one that will one day flourish into a tree that produces Benjamin Franklin's. All right, so this 7-step process will be broken up into 2 sections. 1 before you make the trade and 2 after you make the trade. Now, before we dive into the first step in the before you make the trade section, I need to emphasize that this is the most important step of the entire process. Soon, I'll be asking you some qualifying questions. And depending on your answers, this will determine if you are even able to turn $100 into $1,000 in the stock market. Now, I know deep down inside of my heart that everyone watching this video harnesses the capabilities to do this. Some of you simply just have to tweak a few things here and there to unlock this metaphorical door to success in the stock market. But it's not a big deal because I'm going to help you unlock that door in this first step. So just sit back, relax, and pay attention because if you're truly serious about the stock market, you have to ask yourselves these 2 qualifying questions. So the first question you have to ask yourself is, do you have $100? Now, everyone watching this is likely going to have $100. What I'm actually saying is, do you have $100 disposable dollars to invest in the stock market? The Benjamin Franklin that I am talking about was never meant to be spent on rent, groceries, diapers, or any necessary expense in your life. So if your answer is yes, I do have $100 disposable dollars ready to invest, then congratulations, you have passed the first qualifying question, and you'll soon be on your way to turning $100 into $1,000. Trust me. Of course, that is only if you can answer this second question correctly. We all know that the stock market doesn't just print money every single day of the year. We've seen several crashes throughout history that wipe out people's entire accounts in a matter of weeks. So here's my second question. Can you realistically lose this $100? If the answer to your first question was yes, then your answer for this one should also be yes. Oh, and by the way, the people who lose money in the stock market lack the proper diversification within their portfolios. But you won't have to worry about that because I'm about to go over step 2 where I will share the diversification strategy that took my account from $69,000 to over $125,000. So what is diversification? Why is it so important? And most importantly, how can you implement it into your own portfolio? These are all questions I'm going to answer to you without wasting any more time. Because without this, you're essentially throwing your $100 into a bonfire. All right, so diversification is owning a wide variety of stocks with different characteristics to reduce volatility. And different characteristics between stocks could be a difference in industry, if it's a growth or value stock, or even if it's a dividend or non-dividend paying stock. Honestly, there are a lot of other ways to diversify your portfolio, but one thing is for sure. If you don't diversify your portfolio like I have, you will surely lose all of your money in the stock market. Eventually. Let's take a look inside of my own portfolio so that I can show you what a well-diversified portfolio should look like. Seeing this will help you set yourself up for success in the future. Here you can see my portfolio is made up of several stocks, and my largest stock holding is in PayPal stock with $17,000 total invested. That only makes up 13.6% of my overall portfolio. I also have $33,000 split between 2 ETFs that track the S&P 500 and the NASDAQ 100. This takes up a little over 26% of my account, and this serves as the most diversified part of my entire portfolio. And the reason why I say that is because the S&P 500 is a stock market index that tracks the top 500 companies in the US. And the NASDAQ 100 is an index that tracks the top 100 non-financial companies that are listed on the NASDAQ stock exchange. So this means that 26% of my portfolio is split up between 600 different companies. And you should be noticing real quick that I have an extremely diversified portfolio here. And now I will finally explain why it is so important to have a well-diversified portfolio like mine. And after that, I will teach you how you can implement this into your own portfolio. And this one's extremely important Because if you are starting with $100, you might run into this very common issue that could be easily avoided if you stay tuned. All right, let's dive into why it is so extremely important that your portfolio is protected by diversification. Let me give you an example. Let's say your portfolio only contains airline stocks. The share prices of these stocks potentially will drop altogether after industry-specific bad news, such as a pandemic resulting in widespread travel restrictions and sharp declines in air travel demand. This actually happened in 2020, and an ETF that tracks the top 51 airline stocks crashed by over 60% in 3 months. This means your portfolio without the proper diversification would have gotten hit really hard. In this specific situation, you could have counterbalanced your portfolio by owning some healthcare stocks. So this way, only part of your portfolio is affected. Savvy? In fact, there's a very good chance that healthcare stocks will rise in price because they need to create vaccines to eliminate the virus. Long story short, this could have all been avoided if you simply had your money equally invested in between several different stocks and sectors in the market. Alright, so about a minute ago, I mentioned to you that there's a very common issue that a lot of people face when trying to diversify their portfolios. So for you guys who only have a small amount of capital to invest, say $100 to around $1,000, stay tuned because this is very important. Let's say you fall between this range of only having $100 to $1,000. You're immediately going to run into a major issue. For instance, right now, Meta stock is trading at $610 per share, which literally makes it impossible for you to own the stock since you only have $100 to invest. However, if you pick the right brokerage, you will have the ability to buy fractional shares. With this special type of brokerage account, which I will be sharing with you very soon, you could technically buy $100 worth of Meta stock as a fractional share. And in this case, you would own 1/6 of a share in Meta stock. Now that you know about the common issue that many people face, what is the solution? Choose a brokerage like Charles Schwab if you want the option to buy fractional shares. This is the broker that I have been using for the past 2 years, and I've dropped a link in the description if you want to get signed up to that. All right, so now that we've covered the importance of diversification, you are now one step closer to harnessing the ability to turn $100 into $1,000. I will now be moving on to the next part of the video, where I'm going to teach you how to pick the right stocks to invest into using the strategies that I personally developed over the years that took my account from $69,000 to $129,000. And after you watch this module, you will have the ability to effortlessly make thousands of dollars in the stock market if you stick to what I say. You've done it and I have done it. We've all made a bad trade before, and sometimes it costs us thousands of dollars. When I first started trading, I made a really bad move. It was a trade on a Chinese EV company called NIO that would ultimately cost me upwards of $5,000 in losses. And back then, that kind of money was a big deal for me, and it hurt a lot. Now, I was not following fundamentals at the time with any of my investments, but for NIO specifically, I was just following the hype train that I saw all over the internet. If only I had known how to pick stocks the right way, I could have completely avoided losing all of that money. So without further delay, let me show you a strategy that I developed that can help you turn your $100 into $1,000 as fast as possible. So over the years, I developed a stock picking strategy that worked consistently, and that was by tracking the trades that Congress make. This strategy worked so well that I decided to code a website that tracks all of this stuff and makes finding the perfect stock to invest into incredibly easy. I want to take a minute here and show you how you can easily find and source winning trades by using the software I created. If you haven't heard about this yet, I'll break the news to you. Politicians have been disclosing their stock trades to us ever since the passing of the Stock Act. So I decided to look at the available data, and what I discovered was incredibly disappointing, but also amazing at the same time. I found out that in 2024, 5 politicians achieved more than 100% return in the stock market. And that got me thinking, why don't I just take a look at the stocks that they are buying? And that's exactly what this page is for. And right here, you can see all of the most recent stock purchases and sales that politicians are making. But I want to filter this down just to see Representative Susie Lee's stock trades. And the reason why is because back in May of 2024, our program labeled one of her stock trades most likely to explode in price. This is what we like to call a golden trade. Now, if we click on this highlighted trade, you can see that since she bought the stock, her trade is up over 150%. And it's pushing 170% right now. So our program flagged this trade as soon as she disclosed it because of one main reason, And let me tell you why. The company she bought stock in is called Rheinmetall, an arms manufacturer based in Germany. And what our program discovered was that she sits on the House Military Construction Subcommittee. You see, the fact that she is currently sitting on this military subcommittee and currently trading military stocks, anybody can see that this is a direct conflict of interest. And it's possible that she was obtaining insider information while sitting on this subcommittee at the time that she bought the stock. So by simply leveraging this website, you can be alerted when a golden trade opportunity comes up as soon as a politician discloses their trades. So if you want to use Altoneer to find winning stocks that will take your account from this to this, I left the link in the description and I pinned it in the comments for you to find. So now that we've covered my winning trading strategy that worked so well, I literally coded a website for everyone else to use. It is now time to jump into the fourth step of the before you make the trade section. Actually, the next two steps that I will be covering will conclude this section, and they have to do with more of your own psychology associated with the trade. All I want is to make sure that you are emotionally prepared to make the trade and to hopefully divert any emotionally driven decisions away so that you don't screw things up and lose money. So the first thing that you have to mentally prepare for is the fact that you're going to be holding stocks for several months to even years at a time. Oh, and by the way, I'll explain a simple tax loophole that the top 1% uses. It allows you to pay less in tax if you hold a stock for a specific amount of time. In the example that I showed you earlier about Susie Lee's stock trade on Rheinmetall stock that generated her a return of 150%, she purchased that stock back in May of 2024, which was literally a year ago. So my question to you is this: are you prepared to tuck your money away for years on end? These are things that you must keep in mind when investing in the stock market, and I'll just let you know right now, if you're planning on buying and selling stocks and day trading the markets, it's not gonna work like you think. The most successful investors in the world buy and hold for the long term, and that's what I do. This will help you avoid making stupid mistakes like I have in the past, like when I bought Meta stock at its all-time low in 2022 and sold it for 100% gain instead of a 600% gain right now. I've missed out on crazy gains. And it's all because I wanted to lock in those quick profits and not actually look at the fundamentals of why I got into the stock in the first place. But let's not get ahead of ourselves. I'll be covering that in the final part of this video in hopes that I can teach you when to know when to sell out of a stock. Now let's circle back to this tax loophole that I had previously mentioned. Here's how it works. If you bought a stock 364 days ago and then decided to sell it, your profits on that trade will be taxed under the personal income tax system. However, and this is what the top 1% does, including myself, is instead of selling that stock on the 364th day, we will hold that stock for one more day, crossing that 1 year mark. And now our profits will be taxed under the capital gains tax system. This tax system's tax brackets are much lower than personal income tax brackets. The reason why this is because the US government wants to push people and incentivize people to hold stocks much longer term. And the reward for that is pay less in tax. So just to reiterate, if you hold a stock for more than 1 year, you will pay less in tax than if you had sold that stock within that first year. All right, so now that you understand the importance of holding stocks for longer periods of time, the next step of this process is determining if the trade you are about to make is an emotionally charged decision. I cannot stress this enough. If you cannot remove your emotions from trading, you will lose all of your money. All of it. But that is not the case because I'm about to teach you a very simple trick. It's almost like an indicator that will let you know if you're about to make an emotional decision in the stock market. I love this step of the process when deciding whether or not I should buy a stock because it keeps me grounded and disciplined as a stock trader. It is so important to be your biggest critic because nobody is going to care more about you and your money than you. A few years ago, when I first started getting into the markets, I saw a stock that was getting hyped up all over the internet, and it was up hundreds of percentage points. So being the undisciplined me at the time, I got a little emotional and I got some FOMO, or fear of missing out. And I bought the stock and I nearly lost everything I put into it. If only I had an indicator that could tell me if this was a bad decision purely based on emotions, I could have saved thousands of dollars. So the indicator that I use to remove emotional decisions from my trading is by asking myself a series of 3 questions before I place a trade. And if your answers to any of these questions is yes, then you should not place the trade. The 3 questions you have to ask yourself are as follows. Number 1, is my decision driven by fear of missing out, otherwise known as FOMO? Number 2, do I feel nervous placing this trade? And number 3, are you trying to recoup losses from a bad trade in the past? If you can answer all of these questions with an astounding no, then I think you are making a rational decision. All right, so we have talked about how diversification is so important and how to implement it into your portfolio. We've talked about the politician trading strategy that I developed over the years that helped me take my portfolio from $69,000 to over $125,000 just in 2025. And I have explained the importance of keeping emotions out of your trading to minimize losses in your account. Now we will finally move on to the second part of this video. This is for after you've made that decision and you have bought a stock and now you are holding it. What do you do if the stock you bought crashes? When should you sell for a loss? And when should you sell for a profit? The first thing that I'll cover is what should you do if your stock happens to crash? Should you sell that stock for a loss to avoid becoming a bag holder? Or should you go the other route and dollar cost average down? My goal here is to remove that panic feeling that you will probably be feeling in this situation if your stock crashes and instead make you feel confident in yourself. This will make the whole journey from $100 to $1,000 so easy to achieve. Let's get into it. So what happens if you stick to your investment strategy and weeks or even months after you bought the stock, it is now down 20+%. The reason why I say 20+% is because a decline of 20% or more is considered a bear market. And if this does end up happening to you, firstly, you have to consider the possibility that your original conviction for the stock might have been false. So you need to reevaluate the play and double check your research. Because if you find anything that contradicts your original reasoning to getting into the trade, you should cut your losses now. And if you don't, you might end up losing a lot more money than you think. What you do not want to happen is become a bag holder. Let me tell you what that means. In stock market slang, a bag holder is someone who holds on to a losing investment, often until it becomes worthless instead of selling it for a loss right now. And to add on to this, if you do decide to cut your losses on that losing trade, now you have this capital that's opened up for you and you can deploy that into other investments that might have a better outlook. For instance, think about your favorite restaurant. You love all of their food and the atmosphere is perfect. However, after a change in management, the food quality has went down, the service is slow, and the overall experience sucks at this restaurant. There might be a feeling inside of you that's like, this was my favorite restaurant for years, I'm gonna keep going. But there's another part of you that's like, this place sucks, let's go find another restaurant that's even better. You have to believe that there's a better restaurant out there for you. And so you need to take your money out of this bad restaurant and put it in a good restaurant. All works the same way in the stock market. Now I think it's time that I cover if you should implement dollar cost averaging into your losing stock instead of selling it. So what happens if your stock is down 20+%? You've double checked your work, but you still have conviction for your play, so you're not selling the stock. This is nothing short of an epic money-making opportunity. Why is this? Because you now have the opportunity to buy that stock for even cheaper prices. You thought the stock was an amazing buy at $100 a share, and now that it's trading at $80 a share and you still think it's a good buy, that's an amazing opportunity. I have implemented dollar cost averaging into my portfolio many times. Let me explain exactly how this works and why it is so beneficial to your portfolio long term. So let's go back to that example that I was starting to share with you. If you originally bought a stock for $100 and now it's trading at $80, you can double up your position size and lower that average cost to $90 per share. And then when the stock does rise, you will make even more money and you will be in the green quicker rather than later. All right, so now that we've covered what you should do in the case that your stock crashes and when you should sell for a loss or if you should sell for a loss at all, we need to cover the flip side of this coin and when should you sell for a profit? If you buy a stock and it does exactly what you wanted it to do, it goes up in value. When is the right time to sell for a profit? 10% gain, 25%, 50, 100? There really is not a right answer to that question. And that's because the only time you should be selling out of a stock is when your indicator is telling you to. For instance, with my trading strategy, I follow the politicians' moves. So if they purchase a stock and it goes up 50%, I'm not selling it. What I'm doing is I'm simply waiting for their signal. So eventually when they disclose to the public that they have just sold that stock, I will go into my account and also sell the stock. And selling a stock for profit is entirely based on your investment strategy. So like my strategy is different from yours and yours is different from mine. So your indicator might be something more technical and that's okay. You just need to research what it is. So another way to know when to sell out of a stock for profit is when you are in a trade and it's up and you decide to reevaluate that trade and try to find things that contradict your original reasoning as to when you got into the trade in the first place. If you can find a solid reason to dump a stock for profit, then you should sell it. You can never go broke locking in a profit, but you need to have that solid reasoning and avoid selling a stock that continues to rise after you sell it. I learned this the hard way a few years ago when I bought Meta stock at its 5-year low in 2022, and I was up 100% really quick. And without reevaluating my original reasoning that convinced me to buy in the first place, I sold it. Now, if I did reevaluate it and discover that I should probably hold it, I'd be up 400% on that trade right now. So make for sure that you have reevaluated your stock before making a rash decision like I did. So just before we close out here, I wanted to share some underlying issues I see with most of you that makes it nearly impossible to make money in the stock market. Many of you, despite being in the market for years, still lack the knowledge when it comes to unlocking your full money-making potential. And I know exactly why that is, and I have a solution for you. Just let me explain it first. There's an infinite amount of information, methodologies, and strategies that people have developed over the years. So this begs the question, is it realistic to try and learn it all? Probably not. That's why I figured out that by simply following the people that are already good at trading is the fastest and quickest way you can make money in the stock market. They've already figured out how to trade profitably, so you're essentially using their knowledge to your advantage. In my book, this is the most surefire way to skip that learning curve and immediately start making money. So if you'd rather skip the brutal process of learning on your own and just copy people like Pelosi, who had a return of 70% last year, scan the QR code on your screen or navigate to Altoneer.com to get started with that. With that being said, and I like to do this in every video, if you have watched all the way to the end, I want you to comment ravioli down below and I will comment back. You know, as always, I love you guys and I appreciate all of the support. So until next time, have a good time. Peace out.